Welcome to this week's ASX strategy session. Thanks for joining me. Great having you with me. Plenty of things to talk about this week. A lot of movements in the stock market, some of the commodities moving around. I also want to have a look at any stocks that you're looking at, that you're worried about, that you think there could be opportunities in. I want to go through all those stock codes later on in the show. Now, before we get started, everything today is general commentary only, doesn't take anyone's personal situation into account. Having been through all that, I think we should jump straight into this week's charts. And first one, of course, is the ASX 200. And the selling in the ASX 200 has moved into its third week, with prices losing around another 2.5% since Friday, last week's close. So, does this mean that a final bull market high is now confirmed? I'm going to show you an interesting period from an earlier time in a moment, and I think that will help frame the current situation and hopefully help you manage risk going forward. But let's start with a discussion about this latest sell-off. So last week we spoke about the significance of this support region that you can see here, this blue horizontal line. And that comes in at around 4,100. And it's been a technically active region really for the last for better part of probably about 9 months now. It takes in some previous high points and previous low points. So, as I say, a technically active region. And we talked about the likelihood it would come into play again. That was last week. We talked about, look, prices are probably going to come down, retest this region. And they did that on Tuesday. Prices got down here on Tuesday. We had a brief bounce on Wednesday, but then prices then quickly turned, broke lower overnight on Thursday. So market opened up this morning below that support, the overnight trade, where these markets trade nearly 24 hours. That happened on Thursday. So here we are now, well below that support. And this highlights a vulnerability that we did discuss last week, and that is there's been a hesitation from investors to step up and buy the dip pretty much the whole way down over the last 3 weeks. We're in an environment where every rally is being sold, and it's being sold quickly. These bounces are really only lasting a day or two at the most. So we're in this environment where the rallies are being sold, and I think this points to the likelihood that there's probably some more selling still to come. Now, I think that the next level to watch is a support zone that comes in at around 7,900. Now, let me just draw that in so you can see what I'm referencing. And I just bring that across, and you can see that it takes in some previous highs from mid last year and takes in some lows again from last year. And I think if the ASX 200, and it's not too far from here now, if the ASX 200 is to reach this region, it will bring the pullback to around 8.5%. So an 8.5% from the high in mid-February to potentially down here on this support region. Now, you'll notice that I use the term pullback and not correction. And that's because the definition of a correction is a fall of at least 10%. So this is currently where we are at the moment on Friday at just after 1 p.m. Eastern Daylight Time. It's a fall of about 7.5%. And remember, a correction is at least 10%. Another thing to note is that on average, the market sees about 3 pullbacks of between 5 and 10% each year. So that raises the question of whether this is just a temporary pause in what could still be a larger bullish phase. Now, I know it can be hard to believe that an aggressive 3-week decline isn't the start of something a whole lot worse. But let's just step back in time and look at a similar period. What I'm going to do, I'm going to change this to a weekly chart. to start with. And let me just change that back. So now we're looking at the ASX 200 on a weekly basis. And you can see our 3 down weeks just through here on the top right of the screen. Now let me just compress this a bit. We're just going to step back. Now I want to look at this period where I've got the blue box around. So this was a different time. We'd had the GFC and we'd had the recovery off the GFC. So the market hadn't been at an all-time high, but it was at a multi-year high when this period occurred. So let's just step through this. So what we have here is that like we've recently had, there's a 3-week sell-off back to the 50 weeks. This is a weekly chart, so this is a 50-week and a 100-week moving average. So we've got a 3-week sell-off back to the 50-week moving average, and then that sell-off continues to extend, gets below the 100-week moving average. And at this point, the market was down 10.4%. So over about a five-week period, the market's dropped 10.4%. So we're currently down 7.5%. So this is a bigger decline than we currently have. Prices then spent the next several months moving sideways in a large volatile range. There was when the dip finally was bought, it was bought aggressively, pushed prices back up, came back down, retested the low, stabilized, and then from there we got the break higher. Another decline happened sometime after, but that's not the point of this. The point of this is to say that what appears to be a decline which is just going to keep going. And at the time, how many people would have been saying, oh, look, the GFC decline is back. We're going back to the tested GFC lows. That's the sort of talk that typically happens during these periods. But that wasn't what happened. Big sideways range, and then new highs several months later. So let's just take this back to current times. So is something like we saw during this earlier period, is something like that possible today in this current climate? So let's just sketch something in. And now this is not a prediction by any stretch, but let's just sketch in what we saw in that previous period. So we had the decline, then we had the rally, we had a retest of the low, we had some consolidation, and then from there, prices then started to rally again. So if this is what the ASX 200 happens to look like in several months' time, would that be a surprise? Would this pullback look in place, in character with the previous rally? And I think the answer would be, if you saw this price action in the future, you'd go, yeah, that all fits in. Had a big rally, had a correction, a sideways, and it rallied again. It would fit in. Now, that's not a prediction by any stretch. This is I don't know what will happen, and it will probably be something completely different to what I just drew in. That's just an example to say that there are a variety of things that could happen over the next few months, and they are not all bearish. So I think we need to keep the current decline in perspective. A 3-week pullback isn't a signal to panic and go to cash. Rather, it's a reminder, at least is what I think. I think it's a reminder to have a good game plan and to follow it. That's why we set up these trading rules and trading strategies when conditions are quiet and calm, or we can think, and when things get a bit crazy, well, we go to the plan. We don't then start second guessing it. And so a trading plan isn't just for buying when prices are rising, it's also for managing the many pullbacks that we get along the way. And when a pullback turns into a correction or a bear market, a good plan will respond to those as well. That's what they do. So let's bring this back to the daily chart. As I said last week, we have some cautionary signs, and they being the lack of buying on the way down, the lack of interest in buying the dip, and also we had the warning from a week or so ago about prices consolidating below the moving averages. So they were and they still are signs for caution moving forward. And but saying that, it's signs for caution, not panic. They're very different things. A cautionary approach is very different to a panicking approach. I've continued to reduce risk this week by exiting stocks that have come back and hit their exit levels. And one of the stocks I sold was one where I locked in a 320% gain, which it's a stock which I'd held for a couple of years. And this is what pullbacks or even corrections do. Even your best stocks will come back at some point, hit their trailing stop. So it's not just about losses these periods. It's also sometimes about locking in profits. That was the case for me with that particular stock. Other stocks have been sold at a loss. It depends on the situation. And I'm also happy to hold extra cash during this period until the picture starts to clear up, until prices stabilize and we start to work out, is this developing into something bigger to the downside, or is it one of those on average 3 pullbacks a year? We don't have enough information yet to say which way this goes. But I am still long stocks. I don't want to rush to 100% cash every time there's a 5 to 10% pullback. If I did that, I'd often have to sell my portfolio maybe a few times every year, and that simply doesn't make much sense when you're trying to trade medium-term trends. Now, could things get worse? Yes, they could, but we still don't have the structure associated with more prolonged weakness. That will take more time to develop if that's what we're going to get. I'll be guided by the price action, rely on my calculated trailing stops to keep me in my best stocks for as long as possible, and also manage the risk with stocks which aren't in as much profit, which are maybe earlier or more recent trades. And hopefully that a process of wide trailing stops can help me see off another pullback if that's what this proves to be. But they also act as my backstop should the situation continue to deteriorate. So no one has the answer to what's going to happen. If they tell you they've got the answer, they're just telling you stuff that they don't actually know. So no one knows what's going to happen. But the difference is some people have better strategies than others for managing this. And that's typically what makes all the difference. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Tells people you're watching. YouTube shows other people. Helps heaps. Please do that. And now, having said that, let's jump into the US market because there's lots of stuff to talk about there as well. And then after that, we've got the US and local small caps, the commodities, all your stock codes. We'll go through those pretty soon. Now, S&P 500 first. So this is another case of the rallies being sold, just like we discussed with the ASX 200. And the attempts to rally, they're just not getting any traction. And you can see every attempt to go up, it's pretty much the next day it comes down again. The most recent was on Wednesday. Prices rallied, and then on Thursday, down they come. So the rallies are quickly being sold, and that selling is pushing prices to new lows. And also, like the ASX 200, we don't have the structural change to suggest there's a change in this primary trend. The price action just isn't there at this point to say there is that structural change. And when I say structural change, I'm talking about declining moving averages. So the 50-day, the 100-day moving average, I'm talking about a situation where the 50-day crosses below the 100-day and the averages start going down. That's a structural change. And then also a situation where prices fall and then they rally back to declining moving averages and then they start being sold. We don't have that situation as yet either. The potential for that setup continues to increase, but at this point, prices have only been below the 100-day moving average for about a week. So that's simply just not enough time to call this a bear market. I know people would like to start talking about crashes and things, and anything can happen, but the evidence or the signs and the price action, from my perspective, they're just not there at this point. What has been interesting to see, though, is where the weakness has been coming from. And while there's been a general decline across the US market, the main source of weakness is in the mega caps and also the small caps. So either extreme, that's where the selling has predominantly been coming from. So I'll show you what I mean. I'll look at the small caps a bit later, but let's just start with the mega cap. So there's a good way to do that. It's with an ETF called MAGS. So it's a Magnificent Seven ETF. So the Magnificent Seven, of course, is Microsoft and Nvidia and Alphabet, Tesla, those Apple, all those tech orientated companies are in this Magnificent Seven ETF. And now, what's interesting here, from the December high, this has been down as much as 18%. And it's the decline in this key group of stocks that's putting such significant pressure on the S&P 500, because of course these are the largest seven. They've got the largest weighting. So when these move 18% to the downside, it's a big weight around the S&P 500. It drags it down. Now, pay attention to the January low. This is just make a mental note of this. This is a reference point for a couple more charts I want to show you. Look at this January low. Look how far this group of stocks has fallen since then. They're down about 9% from the January low. So 18% from the top and another or 9% from the January low. Now, let's look at a couple of other markets and just see how this measures up. So the first one I want to have a look at the Dow. Now, when we look at the Dow, here's that same January low. There's a January low, and the Dow is still comfortably above its January low. In fact, at this point, I describe this as a sideways trading range, where prices are just moving sideways following a strong rally. That's not necessarily a bearish setup, what we have there. Anything can still develop, but at this point, it's a market which is range bound following a strong rally. So this isn't a group of stocks that is breaking down at the moment. Now let's go to the S&P 500 on an equal weighted basis, as opposed to the market cap one, which is being heavily influenced by that Magnificent Seven. And when we look at this, again, take a look at the lows from January and look at the current price. It's yet to break below that January low. So, like the Dow, it's also largely in a range below the December high. Prices have been more or less trading sideways. So when we look at this, there is weakening amongst the broader S&P 500 stocks. They are pulling back. So there is general weakness within the S&P 500, but it's within the range, and it's not that more aggressive selling that we're currently seeing in some of those mega caps. And they're the biggest part. The mega caps, well, as I say, they're the biggest part of the S&P 500. Now, just quickly, I'm just going to jump away because I just want to make a point. I want to jump away from the S&P 500 just for a quick moment, have a quick excursion via Europe. So this is the Euro Stoxx 50 index, so the 50 largest companies in Europe. And what's interesting here is I spoke about this bullish breakout here. You can see the blue horizontal line, large sideways pattern. Spoke about this breakout on the 16th of January. And that was in my extended strategy session member content that I spoke about that breakout. We talk about an ETF, etc., that could be used. And since then, there's been this considerable strength through the European stocks. Also, parts of Asia are also strong. So what we're seeing hit the headlines about the US market, about the local market, what I think is important to take on board is this is currently not a global sell-off in stocks. It's largely US mega caps and small caps. I'll talk about them in a minute. And of course, the ASX is being caught up in this volatility. As you can see, it's not a global situation at this point in time. Maybe it morphs into that, but it's not there at this point. So coming back to the S&P 500, at this stage, this remains a pullback. There hasn't been a structural change to suggest that a larger downturn is underway. Again, I'm not ruling that out. That could develop, but at this point, that's not what we have. As I said last week, this could be part of a multi-month period of messy price action where conditions just get hard. And I think this is another reason to de-risk while this heightened uncertainty plays itself out. As always, I generally suggest using wide trailing stops, and this is how I protect capital and how I minimize losses when we get these difficult periods. It's all about having capital ready for when the opportunities return, because we know they will return. We don't know when, but we know they will. So you've got to make sure you don't chop up your capital buying stocks which are falling and just not playing the difficult periods with a good trading plan. Okay, so I'm going to jump to the US small caps now. Then we've got the Aussie small caps, the commodities. Go through all your stock codes. It's a big week to go through your stock codes. And but of course, that wraps up the free section. So if you're not a strategy session member, think about coming across and joining in. It doesn't cost you very much. You get a whole lot more information, and even just going through your stock codes can be invaluable in itself. So think about doing that. All right, so let's go back, have a look at the US small caps. Let's